Hello again and welcome back to my channel. My name is Patrick Allen. I'm a licensed realtor with Keller Williams Southern Arizona. And in today's video, we'll be discussing real estate. If you are a newer real estate investor interested in buying your first duplex, triplex, or fourplex, be forewarned. You are highly susceptible to buying a terrible deal. What type of cap rate should I be looking for in my first deal? Is a given cap rate good or bad for the market? And if cap rate is really just a fancy word for return on investment, why shouldn't you use it to evaluate a real estate deal? Today's video will dig into why I think this is terrible advice and give you my thoughts on what to use instead. So let's start by looking at what a cap rate is. Short for capitalization rate, it's a sophisticated yet simple way of evaluating commercial real estate deals. The cap rate for a given property can be calculated as taking the gross rental income minus all of the operating expenses from the business to derive what we call net operating income, or NOI. Now we can then take the NOI and divide it by the purchase price to give you the cap rate for a specific property. This is a very clean figure to determine not only how profitable a given real estate deal is likely to be based on the price that you pay for it, but also a way of evaluating investor sentiment about the market as a whole. When cap rates increase, it's a reflection that investors have other better options to invest their money, and therefore a piece of commercial real estate must provide a higher cap rate or a greater amount of net operating income relative to its purchase price. Otherwise, they'll simply invest their money elsewhere. And the opposite of this is also true. When cap rates in a market decrease, it's a reflection that investors see few, if any, truly viable assets outside of real estate. And so even though prices of assets have increased for a given purchase price, the net operating income is lower than what you might have expected. Low cap rate environments mean that investors still see commercial real estate as the best place to place their money due to a lack of suitable alternatives in other asset types. So what's so bad about that? Wouldn't it make sense when buying your first duplex to take into consideration not only the money coming in, but also the cost of your expenses going out when analyzing deals? Now, what if your goal going in is to get, let's call it an 8% return on your money in the first year? Shouldn't you just look for a high cap rate deal in order to hit that figure? Now, to answer that question, let's first draw a distinction between cap rate and return on investment. Now, as we just saw, cap rate is net operating income divided by the price that you pay for a piece of property, whereas ROI, or return on investment, is the amount of money that a piece of real estate makes you divided by the amount of money that you put into purchasing the property. So these are extremely similar calculations, and it's completely understandable why so many people get them confused. However, it's important to remember that while they have some similarities, they are not describing the same thing. For one thing, operating expenses that we use to derive a cap rate for a piece of commercial property does not take into account the cost of finance. Whether you are paying all cash for a piece of property or using a loan from a bank in order to buy the deal, or even if you find a way to get 100% financing, it doesn't make it a good deal or a bad deal. If a given investor chooses to finance that same deal, the return on investment will be different than if they paid all cash for it. This is because the cap rate only explains the relationship between the market value of the asset and its net operating income. However, your return on investment is based on the amount of money that you put into the deal. And while a leverage deal will produce less monthly cash flow than if you paid all cash for it, your ROI is still likely to be higher because you have less money tied up into the deal to achieve that cash flow. But more importantly, the biggest reason why we don't use cap rate for non-commercial deals is because for the smaller real estate transactions, we have a lack of standardized variable costs. Let's dig a little bit deeper into what I mean by that. So suppose we are analyzing a 100-unit apartment complex currently being run by a professional property management company. Now, with 100 units under management, it's totally reasonable to expect some level of vacancy and repairs to happen every day, every month, and every year. In a building with 100 rental units in it, it's not surprising to have tenants moving in and moving out every single month. In fact, it is to be expected that if you are consistently raising rents to keep pace with the current market rent for your city, it is something of a red flag if somebody claims to have 100% occupancy for the entire year. Not only that, but with 100 doorbells, 100 garbage disposals, and 100 thermostats, something inside of that building is likely to break and need to be replaced every single day. And so because of that, commercial properties settle into a relatively predictable range for vacancy and repairs, and that figure doesn't really fluctuate too much from one year to the next. Not to mention, in a 100-unit apartment complex, you have 100 independent income sources that typically allows enough revenue to pay one or multiple property managers to manage the building as an operating expense. The management team signs the leases, processes the move-outs, and helps to troubleshoot the maintenance team to handle those small to medium repairs that pop up. When we're talking about 80+ unit apartment buildings, there's certain economy of scale that simply does not exist than if we're talking about 40 duplexes scattered randomly all over the state. Now let's think about a duplex. Is it reasonable to assume that a given 2-unit property might go an entire year without experiencing any vacancy? What if both of the tenants have been in the unit for 5 years or more? Might mean that rents are a little bit lower than what you could potentially get if you placed a new tenant at market rents. The only correct expense allocation for vacancy in that situation would be $0. And if there were no major repairs done to those 2 units in the same 1 year, then the repair line item is also $0. It is not at all uncommon for $0 to be the actual realized expense paid out for property management if the deal is self-managed by the seller. So if we were to look at a financial statement for that same apartment complex, we would recognize immediately that there is no money being allocated for vacancy, repairs, and property management. The seller is clearly misrepresenting the financials. However, the seller of a smaller deal, like a duplex or a fourplex, may not necessarily be lying to you when they said they had no expenses in the last 12 months. And therein lies the problem. When we're talking about smaller, non-commercial deals, there's just way too much room for the seller's agent to pad out the income section and to minimize the expense table to artificially inflate these cap rate figures. So if we can assume in good conscience that this duplex will never experience vacancy, never have a major repair come up, and a property manager would willingly manage this property forever for no charge, well, then it would be totally fine to accept the cap rate stated in the financials, just as you would for a larger commercial deal. But we must also accept an inherent element of unpredictability as to when these expenses will happen. Therefore, in practice, it is actually quite difficult to accurately forecast what percentage of gross rent they will total to in any given year. And so what do we look at instead? Well, I always encourage my buyers the gross rent multiplier. This is the same concept as the price to rent ratio and can be calculated as the price you pay for a piece of real estate divided by the gross yearly rent you can expect to get on that property, assuming no vacancy or repairs. Now, for those of you familiar with the 1% rule, we can imagine a theoretical property that is worth $100,000 and brings in $1,000 per month in gross rent. $1,000 a month is $12,000 a year, and when we divide the purchase price by the yearly income, we have a figure of 8.33. Now, the larger the GRM, the higher the price relative to the rent that it will take in, and the lower the GRM means that either the price is relatively low to the current rents, or alternatively, the rental rate appears to be very high relative to the purchase price. Now, it's important to consider that the GRM can still be manipulated by the seller, either by using an overly optimistic figure for that yearly rent. And so just because a property has a high GRM does not make it a bad deal. It could be that the current rents are well below what the market rents would be if you were to add value to the property or to reposition the asset to create more rental income. And similarly, a low GRM might mean that they are way too optimistic on the predicted rental income, or perhaps they're using figures from a short-term rental like an Airbnb or VRBO, which inherently involves more cash required to furnish, decorate, and market the property, as well as a greater level of risk in the market relative to a long-term rental managed by a property manager. With higher risk, it's very possible to see higher returns. And now, a low GRM might also be a red flag that the property is in a lower class area that is less likely to appreciate over time, or suggests it's the type of deal that looks very good on paper, but due to very small units being rented out at an abnormally high price per square foot, the deal is still likely to attract a particular class of tenant that you might not want to be involved managing. Think of GRM as a screening criteria. Is it worth my time to fully analyze a real estate deal? Or is the GRM so high that there is very little chance of producing enough total rent to cover the operating expenses, as well as the mortgage payment and any other fixed costs that we're going to have? If so, my recommendation is to then use expense multiples to budget for variable costs. And more specifically, my common recommendation for multifamily is to take 40% of the gross rent off of the top to cover these expenses. Roughly 10% of yearly rent is going to be allocated towards vacancy, repairs, capital expenses like major roof and plumbing work that you will have to do eventually, but not likely to have to do that more than once every 10 to 20 years, as well as an expense for property management. Now, if you choose to manage the property, you can then pay yourself. Therefore, we can estimate cash flow by taking the monthly rent, subtracting 40% for these variable costs, and then subtracting out all of our known fixed expenses. Utility bills that need to be paid by the landlord, your mortgage payment if you have to make one, including principal, interest, taxes, and insurance, any HOA dues that might be owed, the cost to keep up landscaping in the common areas, and any other expenses that we will have to pay whether or not the property is being rented. Now, if that number is negative, it's likely not going to be what you're looking for. But if it is a positive number, or if it's close to turning a profit based on these figures, then by all means, take the time to fully analyze the deal using your favorite online calculator, making whatever assumptions about the deal that you feel are justified. So that's it. You don't have to take the seller's word for what the property is likely to earn for you, because now you know how to run this math for yourself. And of course, if you have any specific questions, hit me up in the comments section or send me a direct message. It's my business and my passion to help you get out of analysis paralysis and into the world of actually being a landlord. So I hope you found this information of value. So if you know someone falling for the cap rate trap, tell them to just say no. We'll see you on the next video. Thanks for watching.